Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Jack Crooks is president of Black Swan Capital. He's a currency trader and investment advisor. He publishes Black Swan Currency Currents. It's a free global macro and market newsletter, and you can find him online at blackswantrading.com. He's with us today from Palm City, Florida. Hey, Jack, welcome back to This Week in Money.
Hey, Phil. Thanks for having me. Always my pleasure.
It's good to have you back. Let's have our usual currency roundup, starting with the big dollar. The dollar index up slightly, 79.8 today, heading for almost a 1% decline this week. What's going on with the greenback?
I tell you, it's really a mixed bag with the greenback. I mean, fundamentally, with some things happen in the U.S., you could say that longer term the greenback looks very, very good. And then you get days like yesterday when you have these really outsized moves, big runs-ups in the euro and the pound on what is just, I think, expected news from the European Central Bank. So things like this it really makes it a mixed bag. Longer term, we're bullish longer term on the dollar.
In the latest currency currents, Jack, you're talking about 9 reasons why the U.S. dollar could surprise us in 2013. And a lot of this is stuff that happens outside the U.S. that makes the U.S. dollar look better in comparison to a lot of other currencies. Let's start off with what's going on in Japan and China, where they're basically fighting over rocks.
Yeah, the fight that's going on over the islands could really derail a lot of the focus that China needs to keep on its economy, and ditto for Japan, because Japan, a lot of their demand comes from China. So this fight, which seems to be getting nastier, especially when you see what Japan's doing on their side of the fence, they're starting to change their military rules and starting to rebuild, and it's going from something that looked like it would blow over quickly because, as you said, they're just rocks. Because something very, very nasty here.
Now, you're saying here, talking about the Japan-China conflict, that history can be a bitch. It sure can. And how is that going to benefit the U.S. dollar?
Well, it benefits the U.S. dollar, unfortunately, and you tend to get, the dollar, as we talked about it in these 9 reasons, or there are two benefits from it. One is from the risk in the world. When you have risk in the world, you're going to see money would come out of Asia in this case and into the U.S. capital markets to hide. And the other benefit to the dollar is it moves on fundamentals, good reasons, as opposed to bad reasons in the world. In this case, it'd be a bad reason the dollar would generally benefit, and that's why I say currency trading can be very perverse at times.
Here's something I had not factored into what we're talking about here, the return of Mr. Bunga Bunga, Silvio Berlusconi in Italy. How's that going to work against the U.S. dollar?
It's amazing. He's like the Energizer Bunny. He just keeps popping up. You think he's gone away, and he's back in politics. The reason this could be beneficial for the dollar is he's very negative on the Eurozone. He's very much a Euro skeptic, and has been very, very boisterous against Germany, and what he says is this austerity squeeze that they're basically engineering against Italy. So if he gains power, and his party could end up controlling the Italian Senate at minimum, we're back to that situation where more risk flows into Italy, and we have another potential crisis situation in the euro. That means more money flows out of Europe and into the dollar.
We thought the G20 would fix all of our financial problems for us. Turns out they don't seem to be much interested in doing much of anything. Meanwhile, here's deflation coming back at us, and that's a big benefit to the U.S. dollar.
Yeah, we look at what's going on in the world. If you consider, and I think your listeners will know this just internally when they look at what's been going on, all the money these central banks of the world have thrown onto the market, all the money the governments in the world have thrown onto the market, and yet we haven't seen much inflation or hardly any at all. The inflation, of course, has come in asset prices in the financial side of the fence, but not the standard inflation that we think about. And that shows how powerful the deflationary forces are in the real economy in the world. And the scary thing is we're at a point where these guys are close to out of bullets in here, the ability to tax, the ability to extend monetary policy much, much further. And if that's the case, it's very negative for global asset markets, and there's that risk of bid potential of money hiding in the dollar, as it did during the credit crunch in a very big way. Even though the problems are in the U.S., generated a lot of those credit crisis problems in 2007, 2008, the U.S. dollar benefited perversely.
We're talking to Jack Crooks about 9 reasons why the U.S. dollar could surprise us to the upside in 2013. One of those being changes in cross-border banking. This is something that's below the radar for a lot of folks, Jack.
Yeah, this gets a bit esoteric, but the point is it goes to this cooperation. As you pointed out, the G20 meetings are just almost non-existent in terms of what they get done anymore. It's more like everybody is in this boat, is rats fleeing from a sinking ship, so to speak, from a global standpoint, and every man for himself. And what's happening because of that, the banking systems in the various regions are deleveraging from the world. They're not financing, they're not providing the credit for trade finance and the credit for some of the emerging markets that really need it. So that's a very negative impact for the global economy. If there were more global cooperation, you would see some of that receding of money out of the global economy in terms of U.S. dollar funding improve, but instead it's going backwards. So we're starting to see some of the U.S. dollar liquidity that funds all that trade, and as your listeners know, that trade is dollar based, so people have to have dollars to buy some of those key commodities. But as these banks pull in their horns, dollar liquidity tends to fade, and that means less supply of dollars and generally helps the price.
Jack, we've been watching this trade war with the U.S. and China gradually heat up over the last little while. How's that going to be good for the greenback if it gets worse?
Yeah, again, this is it's funny how the greenback benefits from these very bad things in the world, and that's what a reserve currency does. I hate to keep, not that I'm rooting for these things to happen, but I think that these are potentials. Underneath the surface, there's still a lot of tension between China and the U.S. on the fact that China continues to suppress its currency in order to, push out exports because they're highly dependent on exports to maintain their employment situation in China. So there's still, some very unpleasantness going on in that whole area, and push in Washington to crack down again on China. Washington, in this environment, given what's going on with the euro crisis and the fact that we have so much deflationary pressure in general, has not wanted to pick a fight. But this could rear up at any time, and that's something I think people need to just keep an eye on.
Here's one thing that's obviously going to be good for the greenback, and that's America's rising energy independence. That is good news.
I think it's very good news because if the U.S., this is not to say the U.S. is going to be completely energy independent, but to the degree that it potentially could be, and we're seeing more and more production in the U.S., natural gas, shale gas, things like this, it means the U.S. doesn't have to go offshore to bring that stuff in, and therefore the relative benefit for the U.S. is that its current account deficit declines, meaning U.S. funding stays here in the U.S. for energy as opposed to be spent over at OPEC. So that's a very big benefit for the U.S. and North America in general. So that's one we're watching, and we think longer term, sooner or later, that's going to provide some real positive market sentiment.
From offshoring to onshoring, Jack, this is a great trend. More U.S. manufacturers actually making stuff in the U.S. This is a real switch.
It really is. If you would ask people, a couple years ago, is the U.S. going to manufacture anything again? People would have said they're dead in the water, no way. But the reality is a lot of that manufacturing is moving back because a lot of these multinationals are reassessing what they sent over there. In the example I quoted, I didn't quote in the paper in that particular piece, but I gave the link. General Electric, they're moving most of their U.S. appliance manufacturing back into the U.S. for a lot of different reasons. The cost has improvement because it's gotten more expensive, the labor in China. The transportation cost has gone up about 4 times since 2000 when they shipped a lot of this stuff over there. They realize that they can be a lot closer to the product and make innovations and improve the quality of the product much better if everybody's together in one plant. So they're finding some real beneficial impacts of this that people had said to begin with, is why you should not ship this stuff offshore. But it is coming back, and that is under the radar stuff that I think is going to be, if there's anything very good happening in the U.S., I think that's one of the best things that's happening.
We're talking to Jack Crooks about the U.S. dollar and how it is going to surprise us to the upside in 2013. The next item here, the U.S. lead in 3D printing. Are we going to start seeing 3D money? How's that going to help the greenback?
Well, this idea of 3D printing is a very fascinating area, And a lot of forecasters, kind of futurists, actually see 3D printing as obsoleting a lot of the existing manufacturing space. The ability to even 3D print down to the personal level, have our own 3D printing machines in our home to produce products. Now that gets a little crazy and it's a little farther out, but it's not that far out. And the U.S. has a big lead in 3D printing globally in terms of patents and actual production plants in 3D. So the benefit there is, again, foreign direct investment back into the U.S., not offshoring that stuff. And it's a very, very scary thing for China with those massive manufacturing plants. They could be obsoleted if this 3D technology takes off. So they could have a lot of existing manufacturing space that is, could become basically worthless. And that, and given all the capital that they're spending for the infrastructure bills for manufacturing, this is a trend that they need to watch closely. And at the moment, they're well behind the U.S.
Final reason the U.S. dollar is going to do well, and probably the sweetest of all, farewell to our buddy Tim Geithner.
Yes, that's our illustrious Treasury Secretary, Timothy Geithner. We're no fans of his. And John Ross is my son who works with me. Over the years, he's been Treasury Secretary. Number one, we agree with most everything. We disagree with most anything he's done from a policy standpoint, or most of it, I should say, not everything. But number two, he always seems to be the player out there that they trot out if they really want the dollar hit. We term it being Geithnered if you're along the dollar. He comes out and speaks. We just didn't see any benefit he's really brought to the U.S. From a fiscal or a monetary standpoint, and we're kind of happy to see him go, to be truthful.
What about the new guy, Obama's nominee, Jack Lew? You know much about him?
I don't know too much about him, but I spoke with a gentleman yesterday who actually was in the Reagan administration as Assistant Treasury Secretary, and he knows about him, and he thinks it's beneficial at this point to bring somebody in that isn't from Wall Street. And also somebody in that's close to on the budget. So I just know that from a person I respect likes the choice. So we'll just have to wait and see.
We're talking to Jack Crooks from Black Swan Capital here on This Week in Money. Let's do a quick roundup of the currencies here. Starting, we've talked about the dollar exchange, the DXY. Let's talk about the euro. It is up quite a bit after ECB President Mario Draghi says, "Hey, guess what? Europe's on track for a recovery this year." Do we believe Super Mario?
In the near term, it's believable, and they have made significant progress if you look at interest rates and risk that's been taken out of the system because of what the European Central Bank has done. But longer term, I still think that place is loaded with risk because the political risk is soaring, as we talked about Berlusconi. You also have very big concerns in France. France is starting to target Germany, Spain the same way. And the reality is, these politicos can be happy about what's happened to interest rates, but on the ground, the real economy is still fading, and real people are struggling. So the political risk, I think, is huge, and I don't think the European Central Bank can do much more. So from that standpoint, I think we're going to see the euro come off at some point, again in a very big way.
From the euro to the yen, it is stabilizing after dropping to its lowest level against the buck since June 2010. The Japanese government approving a $116 billion stimulus package, and that could apparently go either way. It'll either boost economic growth or increase the national debt. We don't know what's going to happen.
Well, we know it's going to increase the national debt. I really like we can bet on that.
Yeah.
But yeah, the whole situation with the yen is the new government is in there pressuring not only for more fiscal stimulus, but also more stimulus from the Bank of Japan. But I do think the big structural change for the yen is the fact that now it's running trade deficits, current account deficits for the first time. Really, these have been consistent since the early 1980s. That's the big change, I think, strategically in the yen, and it's weakened incredibly, as you said. We think maybe it may correct in here, but sooner or later, we think it's going to get much weaker because of where it's come from. It's been very, very strong for many years, so it's time to make some of that up.
Let's take a quick trip over to China. The yuan, Jack, rising sharply against the U.S. dollar, hitting a fresh high intraday, rising just a 0.2% against the dollar since the start of the year. We don't follow the yuan very much. What's going on here?
No, we don't. And in those moves, although you get a lot of headline, they're really, as you said, percentage-wise, they're not very big moves. But it does suggest that as China lets its currency appreciate a little bit, it may be feeling some pressure implicitly in the background from U.S. authorities to say we need to get this moving. Ultimately, China, if they really do make a rebalance in the economy and they really have some reforms, they're going to have to let their currency start to rally in here. So it's something we're watching closely. We're just not expecting a big move as of yet.
Jack Crooks, our guest here on This Week in Money. The British pound down from 161 yesterday. The Bank of England keeping its rate unchanged this week. How's that affecting things over there?
Well, most traders expect the Bank of England to add some more quantitative easing to the market, even though they were unchanged yesterday. And the reason is the British economy could be about to slip into a triple-dip recession in here. And you have to remember the British economy is very much tied to the Eurozone, and the Eurozone group of countries continues to go further and further in the recession, and most of the exports from the UK go to the Eurozone. So until that changes, we continue to expect the UK economy to be weak. But we get back to what we talked about. Does that necessarily mean the currency is going to be weak? From a fundamental standpoint, we think the pound goes a lot lower, but in here we're just watching because it's tending to track on the euro. So even if the European Central Bank guy says something nice and helps the euro, it tends to support the pound. So until they are either delinked or we see a change in euro trend, we're still cautious on the pound.
Jack, how's the Swiss franc doing against the euro?
Swiss franc continues to be pegged against the euro. The Swiss National Bank came in and pegged it a while back at 120 to the euro, and they've held that peg. But that is a one currency that could be a real outlier in 2013. If we see another big crisis in Europe, most analysts are wondering whether or not that peg can be maintained because it forces the central bank to come in and buy all kinds of euro to maintain that type of peg, and when there's a crisis situation, it really puts pressure on the Swiss National Bank. So we're watching to see if we get another, spike down in the euro and play in that delinking. The Swiss franc could be a very, very good trade.
Jack Crooks from Black Swan Capital, our guest here on This Week in Money. Let's take a look at the resource dollar, starting with the Canadian dollar. The loonie, it is higher today, near a 3-month high against the greenback.
Continues to trade very, very well. And I think this is a reflection of some of the optimism coming back in the global economy with China bouncing back a bit, at least officially. Unofficially, I think there's still a lot of concerns. But officially, that's what's driving markets. Stocks are continuing to make new highs. So the resource currencies tend to be the risk asset currencies and tend to move well with liquidity in stock markets. And we're seeing that again in the Canadian dollars. As you know, the Canadian trade numbers were not as good as expected this morning, but hasn't hurt the Canadian dollar much. Looks like it can continue to appreciate a bit in here. So we'll just have to see. I think it's all going to be a function of if these stock markets can continue to rally. I think the resource currencies may too.
Yeah, that's a bit of a head scratcher. Our trade deficit jumps to $2 billion in November, and our currency goes up 1/8 of a cent. How does that work?
Yeah, that's just it. Some of the no longer are we tied to some of these fundamentals. It really is, what we talked about earlier, liquidity and central bank moves have been, the main drivers. We are starting to see changes in some of the correlations in these currencies, but of late they're back in correlation with the stocks. So that's the driver at the moment, and they're looking past the trade deficit.
How about down under? What's happening with the Australian dollar?
Tell you, we thought the Australia would break very, very big given what was going on in China. But as I said, China rebounded, and the Australian dollar rebounded right along with it. Even though everybody says in Australia and analysts outside say that the core economy is weakening and in trouble, especially because commodity prices have come off and demand has fallen, even though China's numbers have improved, demand for their commodities in Australia. The Australian dollar continues to trade as a risk asset, i.e. like the stock market. I think we just have to continue to watch that. But fundamentally, we think it's in big trouble longer term.
Okay. Nice bump this week for the New Zealand dollar against the greenback.
New Zealand dollar working even better. It just, again, it moves generally with the Aussie, but it has even been stronger than the Aussie. We're waiting for, again, some negative news in China, and that is one of our favorite shorts. We think the New Zealand dollar, especially given where its short-term interest rates are quite low for a resource country in that area of the world, relative even to Australia, it's not going to get the yield backing or support. So once that starts to change in that area of the world, that's one of our favorite long-term shorts is the New Zealand dollar.
Jack Crooks from Black Swan Capital, our guest here on This Week in Money. I'm looking out the window at the building across the street, Jack, with frost on the roof and a temperature of about -1 in Vancouver. Meanwhile, in Fort Lauderdale, 78 Fahrenheit. It's probably a great time to be talking about that Forex trading workshop you got coming up in Fort Lauderdale.
Oh, yeah, thank you. We're hoping people take advantage of that 78-degree weather here.
Oh, man.
Our Forex workshop, our first one that we're doing on our own, is Saturday, the 19th. Next Saturday, and we're going to go through really the fundamentals of Forex trading, really the kind of stuff you need to know in order to be successful in this market. I've attended a lot of these so-called Forex trading seminars, and they've just been, technical analysis. Maybe this tool is, the holy grail. We're going to really give the nuts and bolts and talk about, risk and price action and really concepts and understanding of how to trade a Forex account, what leverage is, what margin is, all those things I think a lot of people look past and wonder why they lost money in Forex. I think understanding of the market first and then some real grounding in risk and price action, those are our primary goals that I hope people will take away so they can build on it and be successful.
You've also got some pretty good bonuses for folks who go to the workshop.
Yes, indeed we do. We're, again, just to hammer this in, we're giving people a full 1 month access to me whenever they need it, to go over some of the things that we've taught. We're offering a 50% discount for 1 year on our Forex newsletter. So we're really trying to follow this up and really do the right thing for people and really deliver, a lot more value than they expect. So we hope some of your listeners might consider it.
You want to be in Fort Lauderdale, Florida, January 19th for the beautiful sunshine and for Jack's Forex workshop. We would like to see you there. Jack Crooks, president of Black Swan Capital. He publishes Black Swan Currency Currents, and you can find him online at blackswantrading.com. Hey, Jack, thank you for your time.
Thanks, Phil. As I said, always my pleasure.
This Week in Money is archived online at talkdigitalnetwork.com.
Danielle Park is president and portfolio manager of Venable Park Investment Counsel. She wrote the best-selling book, Juggling Dynamite. You'll find her online at jugglingdynamite.com. Hey, Danielle, it's good to have you back on This Week in Money.
Hey, it's been a long time, eh, Phil? It's like a month since we talked.
It has been a while. You have been on vacation in Hawaii. You're back in Ontario, and what's been going on?
Oh, boy, lots have been going on. Isn't it amazing? You really hit the ground running. The new year has brought some resolution of some of the fiscal impasse in a short-term basis in the United States, and that brought a spate of euphoric trading once more in risk assets. So that's been a strong start to the year. And yet we have, the clouds, I'm afraid, still on the horizon with respect to the debt ceiling limit in February and the sequestered cuts that are to kick in March. And so I think we're in the eye of the storm, shall we say.
We've got some short-term euphoria, but basically all they've really done is just kick the can down the road 6 to 8 weeks, right?
Yeah, and then what stock markets have done on the back of that is to trade stocks even higher on their multiples. So all you've had is multiple expansion in the face of downgrades in earnings and growth expectations, and the data, which is gobbledygook speak for saying stocks are even less attractive today as they were at the end of the year because of all that. The problem is that you saw things like Q4 GDP this morning, Phil, being downgraded because the trade deficit for November, unexpectedly wider than forecast, which means that we're looking at a Q4 GDP rate of growth now, perhaps 1%, possibly less. So I was just doing a little back-of-the-envelope calculation, and if that's the case, if Q4 comes in closer to 1 than the 1.5 that everyone had been hoping before, we could be looking at a growth rate for 2012 of something like 1.8% overall. And that is basically flat from the 1.7 we saw in 2011. And meanwhile, stocks have continued to overvalue themselves on this expectation of a world where growth was improving. And I would say at the very best, it flatlined the last 2 years.
If you're following markets, you should be at the Vancouver Resource Investment Conference. That's coming up January 20th and 21st, just 10 days away here in Vancouver. You can find more info at cambridgehouse.com. You were going to be there, and we're talking about markets. You got a great speech on Sunday, Managing Through a Secular Bear. It's a cyclical update of something that you did last time you were here, right?
Well, I usually do two, and one is the cyclical update topic, which and the other is a keynote on the new growth climate in the world and what that tells us about the valuations of current assets, and also about gurus who are expecting a reversion to the old normal anytime soon. And, of course, with the commodities crowd, there's also a great interest in the idea of, where commodity prices are headed, where China seems to be in terms of recovery or stagnation. And I think that's also very topical because, as you know, Phil, commodity prices have actually softened from a peak in 2011. Some of them are down considerably. Gold's off, quite a bit from its peak in 2011. Gold companies and all the other commodities have really been weak, and a lot of people are sort of hoping that that's a short-lived thing and that we'll probably see a big bounce back, but I'm afraid that's not the news I bring. I think, as we saw in China this morning, they're facing things like the worst winter in 28 years, which is translated into food inflation. And food inflation continues to be a big problem for China because of all the people there and many of them having basically subsistence level income. So it's very questionable what more the Chinese government is going to be able to do on a stimulus basis. First of all, because they've already done a ton over the last 3 years, and they're extremely levered now in that economy, both into overvalued housing and all sorts of capital expenditures they've done on credit. And then at the same time, you have stockpiling of all these commodities, Phil. You've got warehouses and, that are just up to the rafters of pretty much every product known demand. So I think it's that excess capacity and inventory, which is a global story, which is likely to weigh on demand and growth as we go into the current year.
Let's take a look at markets this week. They're up peripherally just a little bit, maybe a quarter of a point, a half a point here or there. Earnings season, Wells Fargo, the first bank to file its fourth quarter results. They, of course, beat the street. And Morgan and Citigroup and Goldman, they're all going to report next week. The financial sector expected to be a bright spot in what they're calling a lackluster quarter for earnings growth.
Yeah, well, you wouldn't know that from looking at the consensus view. As you're looking into 2013, the consensus of the analysts is that we'll see 12% growth in operating earnings for 2013, Phil. And I guess my point, back to the whole growth of the overall economy, it seems clear that we're weakening. I mean, the best growth in 2012 was found in the third quarter, around 3%, at least so far, until they revisit and perhaps revise it later. But we're on a down track now, and that's going to affect revenue. Most importantly, that's going to affect revenue for companies. And yes, they can do things to cut costs and manipulate things to come up with, earnings growth. But it's harder for them to do in this environment. They've already been pulling rabbits out of hats for a couple of years here to get earnings momentum out of lackluster sales. Mm-hmm. And I think it's getting much harder for them to keep contorting things that way. So the fact that growth and demand is slowing in the world again, I think it really brings into question this optimistic view. But, the analysts always have that optimistic view, Phil. They did in 2007, and they do today, and they never capitulate until they've really had the teeth knocked out of the whole thing, and then they tend to go bearish just when they ought to be turning bullish.
Danielle Park with us on This Week in Money. Over at the blog, a great chart of the Dow over the last 100 years, Danielle, shows us we're still somewhere in that secular bear market. Are we near the end of this thing yet? What's happening there?
Well, it's the trillion-dollar question, Phil, how much longer? But we do know if it ended now, it would be the only bear market in history, the only secular period that has ever ended with record valuations, historically low dividends. And I just don't think that we are through it yet. So we also can tell from things in the domestic economy, including the level of indebtedness that's still prevalent throughout the world economy, both domestically and in governments. So I just don't see any likelihood that we've miraculously completed this particular bear cycle, which means we've probably got, historically, the average is something like 17 years. We're in year 13 or 14 now.
Okay.
My hope is that we could see one more recession in the next, 12 to 18 months and bring asset prices back to recouple with the reality of the growth world that we're in. The level of growth that we're in is considerably higher than is priced in these assets, and considerably lower than is priced in these assets. And if we could get that recognition and repricing, I go back to, we don't necessarily need the next secular bull to start in order to make money in equity investments. What we need is for prices to come down sufficiently that you can be enticed to buy them for the income they provide. In other words, an attractive dividend is something like 6, 7, 8, 9%, and that's typically what you can receive. At the end of a secular bear, usually prices have been driven down enough that that's the dividend reward that investors can get if they're prepared to buy stocks at that point. But with today, you've almost got unanimous bullish sentiment still, and you've got twice as many bulls as bears in investor sentiment surveys. You've got pretty much everyone on the street capitulating and saying, oh well, the Fed can keep this up indefinitely, so we're going in regardless. And yet, they're all admitting there's huge problems with the economy, but the Fed has really done a number on the psychology today, I think, where they have sort of all thrown up their hands and said, well, we have no choice. We have to go in. We can't sit in cash. We got to strap on the risk. And I think that will be the undoing of this thing, because once everybody's in, Phil, once all the long always are fully loaded, the buyers dry up, and then you see prices stagnate. And once prices stagnate, when most of the players are overly levered, we know margin usage, as an example, is higher today than it's as high as it was, let's say, in 2007. So all you need is a couple of people to start blinking in this environment. There's very low volume of buyers coming in. You got a lot of levered trading, and that's when the surprise, the whole thing starts to unravel.
Boy, 7, 8, 9% sounds terrific. What we're seeing mostly these days is about, 2, 3, 4% in terms of dividend yields?
Not worth the risk. I call it return-free risk. That's what basically people are holding today. And, even junk bonds, Phil, okay, so junk bonds being the lowest potential credit of any paper you can buy when you're looking for bonds in the market. Junk bonds today are yielding less than 6.
Wow.
So in the good old days of anything close to normal conditions in the world in the last 200 years, government bonds, U.S. government bonds, for example, would average something like 5%, 5 to 6%, and you'd get, mortgages around 8, and you'd get, junk bonds paying more than 10, sort of like 12%. And so that gives you a sense of where we are today, when everything has been bought up in desperate search for yield. And that is just the surest way to lose your shirt that has ever been documented. So I caution regular folks out there. I know there's huge pressure right now on people to just try and, throw away stability and go for risk to grab a few percent. But that is not likely to work, and I'm afraid for them, because another big bear market is in the cards. That's just the nature of a secular bear. The question is, the person that's buying now, what's their sell rule? And I'd suggest they probably don't have one.
Would it make more sense, rather than jumping in, going all in, to just kind of put in a little bit at a time over the next little while to ride these cycles up and down?
Well, it goes back to really your age and stage. If you're young and you're kind of saving $200 a month, you might want to do exactly that. You might want to set it up into a balanced, low-fee, balanced, ETF or mutual fund, and just kind of slowly chip away like that. But for anybody that's sort of amassed a bulk of money already, it's much harder, because you really don't have the time or the tolerance, frankly, to lose a large chunk and then to, be able to make that up over the next 5, 10, 15 years. So I think once you're sort of in your late 40s, 50s and plus, and you've got the bulk of your life savings, or you've already sold your business, you really can't do that kind of it's just not a practical solution to, put a little bit in as you go.
Yeah.
I would say, though, when we see, that chart that I put up and some of the other technical work we've done shows that there's a bottom in the S&P. It's tested it twice before in this secular bear, around 800. If we could get something there, it might make sense for people to, to start tranching in. And of course, you always have to be aware that things can overshoot to the downside once the pessimism really gets going.
Mm-hmm.
So maybe that makes sense. You leg in with some of your capital, and then if it breaks down further, maybe you leg in with a bit more. But I would say, looking at that chart and knowing that the S&P is now, back at the same, very close to the peak it was 5 years ago, very close to the peak it was in 2000, Phil. It really makes one shudder with concern for capital that's left riding on that wild beast at the moment.
But isn't that human nature for people to look at it and say, gee, it's at the highest point in 5 years, I can't not be in the market?
Exactly. So you really have to get a grip of your human behavior and fight that impulse, because it is the most destructive force. And the other thing, which is tragic, and I've seen it in my own practice, I've met people, who are just saying, I just can't wait. I can't sit, in safe things for now. I can't step out because I'm desperate for income. And I'm always saying to people, please get yourself a part-time job, or rent your basement, or sell off your houses, or do something except throw yourself under the bus in the desperate need to increase your income right now, because that's just such a dangerous thing to do.
Danielle Park from JugglingDynamite.com, our guest here on This Week in Money. We've got some more great video over at the blog from our friends at CNBC. Here's Martin Feldstein. He's a professor at Harvard University. He says the Fed's going to wreck the U.S. economy unless something serious happens.
Well, I think the Fed has wrecked the U.S. economy. I mean, them in conjunction with the credit wizards and everybody who piled on leverage in the last 15 years. But, he's just pointing out that we've tried the QE experiments. Mr. Draghi and Mr. Bernanke have really damned the global economy to a much longer secular bear period, in my view, by their efforts. If they had not stepped in to try and reflate the garbage that shouldn't be trading at the price as it is, they reflated it quickly in the hopes that would help a few people. And really what they've done is just elongated the suffering, because they haven't let anything heal or fix itself. And I think Mr. Feldstein is just saying, I think enough's enough now. We've tried the experiment. We're giving them the benefit of the doubt. Maybe they meant well. It was a theory. They wanted to try it. All that's great. But after so many whacks at this, and now they see that the economy is weakening, you got a recession in most of the major economies in the world, and probably in the U.S. again, it's time to admit. And the other thing is it's aiding and abetting the political dysfunction, because it's keeping rates artificially low. That keeps the pressure off of, the overspending governments of the world to not take any serious steps. The same things happened in Europe, Phil. You saw the bond market spiking, even last summer, with the realization that Europe has too much debt to ever repay it. But when Mr. Draghi said, we're going to come in, we're going to be all in, we're going to back it, we're going to buy all this garbage debt, rates subsided again. And then, of course, governments right away say, oh, there's no crisis. We don't have to actually reform fiscal policy. We don't have to change anything about what we're doing. We can continue fighting like teenagers and doing nothing productive. So I think that's really the danger of all this action from Federal Reserves is, they're just tinkering with it, not allowing any healing or progress, and creating even bigger bubbles, which are even more dangerous to people who are already undersaved.
Danielle, our friends in China busy celebrating the Year of the Snake, and talking heads everywhere talking about how China is going to have a soft landing, and very soon we're going to be back to China as the world growth engine. But you're saying, wait a minute, not so fast.
I just don't see the data to support that, because, I was saying at the time, Phil, 06, 07, 08, that, China was voraciously consuming every raw material known to man, but not for their own consumption per se, for exporting goods, finished goods, to the rest of the world, to the Western consumers and that sort of thing. And also for building tons of property, buildings, subdivisions, homes, condos in their own economy. So they were very much a capital spending driven domestic economy, where 60% of their GDP was coming from the government, funding these projects. And the rest of their growth was coming from Westerners demanding goods. Well, that all came to a crescendo, as we know, in 2007-8 now, and since then you've had this burst in the domestic credit bubble, in the consumer credit bubble, which coincides with the burst in the commodities bubble. And so people that are, thinking that China is bouncing back to that climate any day soon, I think are doing themselves a great disservice. The reality is they've got huge capacity and overinvestment and, as I said, inventory.
Yeah.
And they've got a weak household consumption rate in China. They still save 30% of their income because they still don't have great safety nets there. And so I think, they're going to struggle. If they can have growth above 6%, I think that would be considered really good in this environment. Yet most people, throw up their hands and say that would be catastrophic for the world. And the clip that I put on is that, what they did some at Societe Generale, they just did some stress testing to say, what if Chinese growth was 3 or 4% a year? Gas, what if that happened? What would that mean for certain sectors, and certainly for commodities and commodity currencies? And not surprisingly, the verdict is it would disappoint in terms of revenue, and I think that it'll continue to portend some weakness for the Canadian economy, for Brazil, for Russia, for various places that are very dependent on selling rocks and trees.
Danielle, you have another great CNBC video on your blog. Dr. Doom, Mark Faber, with his investment outlook for 2013.
Yeah, Mark's, we've interviewed him before, and I was just interested in an update on his thoughts because he's sort of a citizen of the world. And, he's saying he's basically always got certain allocations to gold and global real estate and that sort of thing. But he's also looking as an economist at this trajectory of growth, which I'm talking about. The new normal in 2013 and 14 is for significantly slower growth than we, have come to expect.
Yeah.
And I think that causes, it's not the end of the world. It's just that if asset prices are expecting unrealistic growth and they don't get them, that ultimately always comes home to roost, and it causes people to start selling. And as I say, that can have a cascading effect that can wipe out a lot of unsuspecting net worth.
Danielle Park is president and portfolio manager of Venable Park Investment Counsel. She wrote Juggling Dynamite, an insider's wisdom on money management, markets, and wealth that lasts. You can find her at jugglingdynamite.com. Don't forget, Danielle's in Vancouver next week at the Vancouver Resource Investment Conference. That's coming up January 20th and 21st. You do not want to miss it. More information at cambridgehouse.com. Hey, thank you, Danielle.
Thanks so much, Phil.
Thanks to our guests, Jack Crooks and Danielle Park. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.